All right, the broadcast is up on YouTube. If anyone has a direct link to it that they can post, I would appreciate it. And I'm just waiting on, not sure why this VTF has been slow for me recently. Just waiting on the VTF screen share. There it is. Okay, we are on virtual trading floor. Again, people tell me when I'm streaming on both that the quality's better on the YouTube itself, so you can follow along there, but definitely if you have questions, post them into the virtual trading floor. I am an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA. All trades placed by me are placed through T3 Trading Group. You should carefully consider whether trading is suitable in light of your own financial condition. Position disclosure. We keep the compliance department happy and everybody is happy. Okay, let's jump right into it. All right, so decent percentage update today. It feels like, you know, traditionally 2 to 3% up days were huge up days. But with the volatility that we've been experiencing recently, we'll call it a decent up day. SPY's up 2%. Qs are up 3%. And the IWM, our laggard, all day today, still ended up posting a pretty decent 1.5% uptick. Let's see, technically here, if today's up move changes anything big picture for our technicals. And the answer is really no. You know, it's a good start for sure. SPY's posting a pretty strong day. Definitely a good thing that we're able to recapture 420. If you all remember in the morning meeting today, I kind of talked about how, and this is coincidental, I think it doesn't have to always be this way, that the market does tend to some degree to kind of gravitate towards whole numbers. In the SPYs right now, every 10 bucks has been important. 420 is important. Did something just happen on my VTF? Oh, there we go. Just got a weird notice there. Anyway, every $10 in the SPYs here is really important. 420 is an important level, 430 is an important level, and 440 is an important level. One of the things, what do you mean, Sebastian? You don't see anything? In the VTF here, try restarting your, okay, I don't know, like I said, I was having a weird delay on my side too. All right, let me jump back into it. Every $10 is important, and what I was about to get into is one of the exercises that I think is a really good technical exercise to do when you're analyzing the big picture of the market is ask yourself, bullish, bearish, neutral. So I love just kind of looking at the market, figuring out, are we currently bullish, bearish, or neutral, and at what price points would that change? So we are clearly bearish right now for the SPYs. We are bearish for the Qs, and I would argue IWM underneath $200 is bearish also. So we have a continuity across our indices where everything is still pretty technically bearish. And you know, what I was saying right in the beginning of the meeting is, does today's up move, which again 2 to 3%, S&P, Nasdaq, really solid up move, does that change the technical picture? Does it get us from bearish back to neutral? And I would say that the answer to that, at least so far, is no. We are still clearly in a downtrend. Today is a nice up move. Do we break any recent pivot highs? No. Did we reclaim any major levels? Maybe you could argue, okay, we reclaimed 420, which is a good start. It's at least the bulls defending themselves a little bit. But we didn't really clear any major upside levels. We're not above SPY 430. We're not above SPY 440. That could get us kind of into more of a neutral or potentially bullish zone. SPY 430 is really important. We can see that here on the chart. Off of the last major bear market rally that took place on February 24th. Huge 2-day rally, by the way. Makes today's rally look like peanuts. You know, we rallied from 411 to 438 in 2 trading sessions. Massive. After that, we established some support. It was loose at about 4:30. Really, if everyone remembers who was part of the team, 2 weeks ago when we were in that area, really we were calling it a support zone between 427 and 430. I would prefer at this point to kind of just round that out, excluding these tails here, to 430. 430 now also is exactly where the 21 EMA is. So we've got a lot of potential resistance here at 430. And if we're able to start clearing above that, this market gets more neutral. And then 440 is also a huge level. So the question I'm trying to actually ask myself right now is, would I consider us going from bearish to neutral on the close above 430 or close above 440? I had been saying for a while 440 was the level to kind of get back to neutral, but as the market works its way back down, as we get new lower highs and new resistance levels, you could definitely make an argument that above 430 is where this market goes from bearish to neutral. And I still, at this point, think it's all the way up here at like these 458 pivot highs, which were the highs from the January bear market rally. That's only above that the market really gets like clearly bullish up on that point. So those are our key technical levels. And while the S&P is still below those technical levels, while we are still in bearish territory, and while at the same time we have confirmation from the NASDAQ also being bearish and the Russell also being bearish, what that very broadly means, if you're trading in a vacuum without any other information, is that you are going to be better off selling than buying. You're better off shorting rallies until that changes. If we get back into neutral territory, that's where the market becomes probably a bit more two-sided. That's when you can do, and even though we were looking to buy relative strength today, you can have a lot more confidence that you might be able to get follow through to the upside on relatively strong stocks in a neutral market while still being able to short relative weakness on the downside. And then it's if you get into the bull market territory, which we were in for a long time, but now we're a ways away from that. That's when people who've been part of the team for a while just hear me constantly saying, you're just better off erring to the side of the longs. You're better off erring to the side of the longs. You're better off, kind of continuously coming in and buying. So, for right now, again, really strong day today, notable volume, not really giving us too much confirmation. I think short time frame here, we need a close above 430 for the S&P to even begin to kind of get back to neutral territory. Now, again, we're not trading in a vacuum. We're trading actually in kind of a crazy environment where there's new news that's constantly hitting. I think I was speaking a day or two ago about how this market just can't catch a break. It seems like once we begin to maybe price in inflation and Fed hikes, then Russia-Ukraine happens. Once Russia-Ukraine happens, we begin to price that in. Next thing you know, potentially more supply chain issues coming out of China is what we were dealing with yesterday. And then on top of that, we have this Fed meeting tomorrow. I know a lot of people in the afternoon session today were asking me questions about, where do I think this or that will be tomorrow? And the answer to that is really heavily dependent upon this binary news event that we have tomorrow, which is Fed. Fed at 2 o'clock. I'm assuming, if I haven't read it yet, that he's going to be doing like a Q&A at 2:30 with the press, because he often does, especially given that this should be the first Fed interest rate hike that we've seen in quite some time. I guess let's spend a little bit of time talking about the Fed tomorrow, and then we'll talk about it again tomorrow morning in the morning meeting. Whenever it comes to these types of events, it is always about surprises. So you always want to know, what is the market expecting? And if a lot of the times, if the market just gets exactly what it's expecting on like a Fed news, you get a whole bunch of volatility and we end up nowhere. So what is the Fed? What is the market expecting? Market's expecting a 25 basis point hike. I think at this point a very low probability surprise is a 50 basis point hike. 50 basis point hike, we're going to see a lot of volatility. I don't even know how the market would resolve itself on that, probably to the downside. But I really don't. I didn't even think, personally, even when the Fed was, when the market was pricing in a 50 basis point hike, I didn't think that was going to be happening even then. And now, Jerome Powell basically said to Congress or the Senate, or I forget whoever it was, a couple of weeks ago, he almost basically said, yeah, we're definitely doing a 25 basis point hike. So that is what the market is expecting with a very high probability. What there's a little more uncertainty around is how many more rate hikes he's going to signal, and offloading of the Fed's balance sheet. So we really got to pay attention to language around that. It sounds like, according to the information that Pat and you guys actually gave me earlier today, because I haven't yet done my complete research on it on my own yet, that the market is pricing in 7 25 basis point hikes. That is a lot. I've been a skeptic of the rate hikes, honestly, more or less from the beginning. I think that it'll start to happen, and I did think that inflation would kind of come down kind of quickly off that, particularly off the supply chain stuff. But now with the new information on China that we had yesterday, that actually might not be accurate. So again, we know what the market seems to be expecting. Let's see what they actually hint at. It's going to be a lot of kind of back and forth language. We've seen Jerome Powell in these press conferences and when he's speaking sometimes contradict himself literally like within 3 sentences. He'll say something that sounds dovish, the market starts to rally, and then he says something literally 3 sentences later that counters what he just said that was hawkish, and then the market comes all the way back down. I think that we might have experienced that actually just on the last Fed policy meeting. So we'll see. It's definitely going to be a that was the language we were using, right? We were calling him a dovish hawk. So we will we'll see how all that plays out. I am inclined to think that if there is no surprise at all, that the market's going to lean to the upside. That's a difficult thing to kind of say or predict because the market technicals are still so bearish. And over the course of my career, I have found that news moves do tend to err on the side of the technicals. But I also know that the market doesn't like uncertainty. So it is very typical that when we get past an event that there is uncertainty around, even if on the surface it came out poorly. Sometimes you'll see the market rally because they just go, oh, thank God we got this out of the way, and the market can actually catch a bid. So in the event that there is no surprise in either direction, your technicals still do say lower, but there is a chance that you would see a further relief rally just based on the fact that we have a degree of uncertainty out of the way as far as markets are concerned. So it's going to be really interesting. And then from a technical perspective, if it does lead to a rally and we can get back above 430, we also have to continue to remember the type of market environment that we're in right now. And again, this is where reading Pat's note that Pat posts at 8:30 is so important. We are in a market environment of high volatility, low liquidity, negative gamma. All of this stuff can mean, and not to mention extremely bearish sentiment and extremely bearish positioning. All of that stuff can mean that a bear market rally could be very vicious to the upside. Or even if eventually it resolves to the downside, Pat brought up a great piece of notable information when he was on the radio into the close, talking about how the Fed actually legitimately doesn't want the market up too much. So if the market starts really ripping and we get back to bull market territory, that's just even further ammo for the Fed to raise interest rates faster and harder, which kind of brings the market back down a little bit more. So that kind of does keep, I think, and I totally agree with Pat, a little bit of a ceiling on this market. But it doesn't mean that you can't have a vicious kind of bear market rally based on the current state of the market mechanics. You really can. But at a certain point, you start to run into issues of Fed tightening even faster on it. Because here's kind of the dirty truth of the inflation situation is one of the reasons why we have inflation, and again, this is X food and energy, which is I think the food and energy inflation is a totally different conversation than the goods that you're buying from Target or Bed Bath & Beyond or Amazon or whatever. The inflation that I think that you're seeing in those goods is based more on the supply chain issues. And why, right? And why is that? It's because there has been a supply and demand, what's the right word I'm looking for? Like anomaly. There's been like an anomaly between supply and demand, where you've got all of these Americans who are so flush with cash. And what do we know about Americans? They like to consume. We got all these Americans that are so flush with cash, and all these companies that just can't keep up on the good side of things because of the supply chain issues that are still coming off of COVID. So the Fed understands, well, if we can keep the market down, if the YOLO meme traders are all going broke because AMC went from 60 to 13, well, they're probably not going out and spending that money on new goods, right? So they understand that. So they don't want this market to get too high, because it can further exacerbate kind of the inflation problem, and they'll just increase interest rates. So, really interesting information when you kind of combine understanding these different market dynamics with how the Fed is kind of set up right now with the inflation situation. The only way that I think that we'll begin to see a really sustained bull market again is if inflation comes back down. And that could happen in a number of ways. I think it's still going to be really difficult on the energy side of things, but that could happen by just supply and demand kind of catching up, and inflation beginning to work its way down. And then the Fed says, you know what, we'll continue to hike, but we don't need to hike in the way that we need to hike right now to bring inflation down. And then you go back into the virtuous bull market cycle that we've had for the last 10 plus years. That's kind of your ultimate bull market case. And it's hard to assign a high probability on that case, at least as right now. We're very far away from it. So that's kind of what we can expect. And again, all of that information really leads itself to a potential big picture thesis of a lot of sideways volatility going forward, possibly leaning towards the downside of things. But I'm not really in the business of making grand gestures like that. It doesn't put money in my pocket. I do think that the CNBC pundits, if you will, they love to just say, give these huge grand predictions on markets significantly higher or significantly lower, and it doesn't necessarily have to be that way. Like the ultimate, not to get on too much of a tangent, but the ultimate waste of time is how the CNBC pundits at the end of every calendar year give their end of year prediction for the following year. You've got no idea where the market's going to be a year from now. You've got no idea what type of new virus is going to come around, or war is going to come around, or the opposite. You got no idea. It's just such a waste of an exercise. So I really love to take things kind of day by day. And where we are right now, decent looking bear market rally today, did not get us above any key levels that changes the narrative of this market. We are still technically bearish. Rallies technically should be sold, but we're going into a major event tomorrow that has the potential to change the picture or not. And I have no idea what I'm going to be saying to you guys at 10 after 4 tomorrow when the market closes, after we've heard everything that the Fed actually has to say. Also just notable, I'll repeat this tomorrow morning, Fed days midday tends to be times when you don't want to trade. And, I hate saying that, when we have all the guests in the virtual trading floor this week. I want to tell you guys about, press button, so much opportunity, all that stuff. But I can't do that. Tomorrow morning we'll get the usual opening price discovery, price action that you can take advantage of. And then typically on Fed days, not 100% of the time, but typically on Fed days between like 10:30 and 2, you really don't want to trade. Or very minimal position management, things like that. You just tend to not have an advantage. The market, the whole market more or less begins to chop around and sit and wait for what's actually going to happen at 2 o'clock. And from a risk management perspective, definitely don't, risk your whole day before 2 o'clock tomorrow, because there could potentially be big opportunity post 2 p.m. for us to be able to make money. And the worst thing that you want to do is to have triggered your personal daily max loss by 10 a.m. and sit out through that. So that is kind of where the market is. I already know that there's no real difference on the picture here in the Qs. Q snapping back to the 80MA on the daily chart, so we are no longer extended to the downside for the NASDAQ. Honestly, that's even further ammo for bears to be able to come in and bring us lower. The NASDAQ has to reclaim 335 and then 350 are really key levels here. 350, this kind of goes back to what I was saying about SPYs. Do we become neutral above 330, above 430 or above 440? And it's a little bit tricky. And it's kind of a similar situation here with the Qs. I had been saying we needed to get above 350 to become neutral. You could definitely be making an argument that if we start kind of reclaiming on a closing basis like 335 and the 21 EMA, that maybe we start to become a little bit more neutral. But definitely, you're only really becoming bullish if you start getting above like 366. So same picture more or less with the Qs, and we're no longer extended to the downside. IWM with an inside day today. IWM was relatively weak yesterday. It was relatively weak today. Notable because the IWM has been relatively strong for the last month and a half, but it is what initially led us down back in November of last year. IWM above 200, I think, is neutral. IWM above 207 is where it actually can become more bullish again. So IWM, because of the relative strength that it's shown here over the course of the last month and a half, is actually much closer to what I would consider to be bullish territory than the SPYs or the Qs. But, again, one day at a time. As far as individual trades go, once again, just a really solid day today. Almost every opportunity that we discussed in the morning meeting worked out really well. I'll kind of blast through the morning meeting ideas today, starting with energy. We talked about XLE long versus $70. $70 being a previous resistance level that we broke out from to act as future support. Low of the day today in the XLE is $70.44. So if you're willing to pay up a little bit, good inside 5 and up off of lows here in extended territory, you got some decent stock. I would describe the XLE close as okay. Not really giving you like a very satisfying pivot off of $70. This overall has been our relatively strong sector. This has been the sector that I've been talking about coming in and having the volatility give you a really good dip buying opportunity to be able to get stock. So that one is an okay trade today. It worked out. Just an okay close. We'll see what kind of follow through we can get on that. And in the energy sector, the one I particularly was interested in was Apache off the $35 area. Low of the day today is $34.79. So you may have gotten shaken out if you were just directly, purely buying off 35. Similar trade here as the previous resistance that we broke out from. You got to understand that these levels can be a little bit loose sometimes, and that's why I love using smaller time frame execution for a bigger time frame reward. And to be honest with you, the execution looks difficult to me here. Whereas the XLE kind of gave you this clear inside 5 and up and extended territory in front of $70 that you could have taken advantage of. Apache, a little bit sloppy from an execution perspective in front of $35. So you kind of had to really be thinking, I think, bigger picture, because I'm not seeing that like really solid 5-minute entry bar, that I'm always kind of looking for. We talked about rig off of $3.80, also in the oil space. Low of the day today is $3.80. So that one actually held like literally to the penny. That's a spot that we broke out from. Also stands to be a kind of a benefactor of obviously new oil pumping as oil prices go up, and we kind of need that to happen. Also not a fantastic close on this, not a fantastic looking daily candle, but an okay initial day here to be able to hold that level. We'll see if this actually can be a pivot low that leads to higher price action for rig and for the energy stocks. My favorite ideas of the day from the morning meeting today were Peloton and SOX-L, the semis we also spoke about broadly. Peloton, we identified the upgrade this morning, and what I did say about this Peloton was I don't love, there's like no great daily chart setup here, and I don't love buying directly into the 80 MA. But what did we have on the side of trying to be long Peloton? The fact that this showed really sound relative strength yesterday off the open, good relative strength yesterday off the open that was eventually thwarted by the market. Solid upgrade today. And I think from a kind of a bigger picture perspective, the fact that this is back down to $20 when it's a very high probability, or I don't want to say very high probability when I'm talking about a buyout, but there's a higher probability than for your average company that Peloton's getting bought out. I mean, you know, we saw this uptick here on the market because basically Amazon and Nike said that they were interested in buying the thing, and it almost looked like there was going to be a bidding war on it. I thought maybe Apple would be a good player for this too. That was my thought process months ago. Just imagine all of a sudden every Peloton has an iPad right in the middle of it that would also be able to bring Peloton into the kind of Apple workout type ecosystem that they're trying to build there. So, you know, some definitely interesting things along with that upgrade today in Peloton that had us looking at it. This I know was a major focus for a lot of you right off the open. A lot of you guys said you got involved in this. I had called out a buy pretty quickly here, I think before it touched $21, but after it put this low in versus the low of $20.56. So you could have gotten in that. If you missed it, this actually was a little scary, right? When the market pulled back, small time frame here, and I kind of went over this a little bit in the class, so I don't need to go over the small time frame technicals too much, I think, for the SPYs or Qs, but you had that technical price correction down to equilibrium because it was technically a common gap to the upside. Common gaps tend to get filled, so we can get into the supply and demand implications behind why common gaps tend to get filled, but solid pullback here to your technical equilibrium inside 5 and up, and that caused Peloton, which is trying to be relatively strong, to retest but hold the low by 2 cents. You guys remember yesterday when I talked about how everyone always loves to dwell on when they don't get stopped out, or sorry, when they do get stopped out at like an absolute low and get shaken out of a position by a penny, but traders struggle, and this is like a psychological thing, to talk about when the market saves their butt by 2 pennies. Well, this is a perfect example. Some of you guys, I know for sure, because you communicated it, were using this opening low as your stop loss. That opening low held by 2-3 cents here, and then gave you a pivot point to really, really work well off of, and Peloton definitely turned out to be a trade of the day today. Semis, was really liking the semis today. We talked about Micron, we talked about AMD, we talked about NVIDIA, we talked about all those things this morning. AMD above $100 was an idea. That idea held out and worked out really well. As a matter of fact, this kind of descending channel here in AMD is even potentially beginning to break to the upside. I don't want to overread that, especially with the Fed news that's coming out tomorrow. Pre-market low in AMD for the early birds out there was like $100.20 or something. Great opportunity to get stock if you woke up early off of pre-market lows. And honestly, my best buys of the day happened at like 6:15 or whatever it was this morning when I first logged in. I was able to get Apple at 150. A couple stocks there really below the low of the day, which was solid. AMD I did not get, but you know, good opportunity there. So we talked about AMD off $100. Sebastian had brought up that chart of NVIDIA there as a potential kind of smaller time frame breakout. NVIDIA not my favorite, but we did kind of discuss the broad support area 210, also held and worked out. Micron, we talked about the downside extension here getting a little bit silly because Micron's been one of the most relatively strong semiconductor stocks, though it broke down with the market pretty recently. Great opportunity, red dog reversal, Oldensmith overthrow, whatever we're calling it these days, as a trade to the upside. It's still a lot more room to the upside on Micron. So you could have traded any of those individual names. My favorite one was actually looking at SOXL. So we talked about this huge daily area support around 27.50 in SOXL today as something to kind of be long. And again, one of the things that I love to do is take the big picture information, which is all we really know pre-market when we're doing our morning meeting, and then try to find smaller time frame risk execution based off of that big picture information. So we know how these semiconductors are looking, we know where their support levels are, we know this 27.50 is huge in SOXL, and I was a little bit concerned because the market here, I was a little bit concerned because we've been in a bear market that we might not actually hold this equilibrium and pivot back up like we did. But Felipe, who is a brave soul, and you know, if I may say, one of the best traders in the ProDesk virtual trading floor for some years now, said, I'm coming in and I'm buying this thing. He said, I'm coming in and I'm buying this thing kind of versus lows as this inside 5 came in. This inside 5 was a great execution setup for when you've got all of that other kind of information that's in there. And here's your inside 5 and up. I mean, you literally could have bought this thing for less than 40 cents risk. And then the upside follow through on this thing was $3, and you're probably still in the trade. I know Felipe said that he was swinging 30% of the position that he bought from there. Same big picture problems, running into the ADMA market, all the stuff that we already discussed. But what I discussed in the class today, win-win situation. What's the worst case scenario for this trade? Is it comes back down, get stopped out at the initial stop loss that you have, and you make money on it. What's the best case scenario for this trade? Fed says something good, market gets back above 430, gets a little bit more neutral, volatility's big, and this thing works its way back up to 45 bucks. You could definitely see stock sell back at $45. Next thing you know, you're entering a trade for 40 cents risk, and you're deriving $17, $18 worth of reward on it. That's what I'm talking about on the overwhelming risk reward that we want to be able to shoot for, that's going to generate the big bucks for you, even if it's just that remaining 30% of your position that you're becoming super greedy on. If you're able to capture it, it doesn't have to happen often, but you get that overwhelming risk reward just once in a while. That can make your month. So really, really good stuff there. Semiconductors were discussed in the morning meeting as something to really focus on. I spoke about the airlines today, and I mentioned that there's a trade here, but I definitely have less conviction in them. We talked about Delta long versus 33.50. We talked about United long versus 36.50. We talked about JetBlue long versus $13. All those trades, if you're able to get stock, kind of really worked out to one degree or another. So that was kind of also solid. And then finally, we talked about the Chinese stocks. Honestly, I said the Chinese stocks are getting silly here. And I said, look at the volume in that Alibaba today. I still think the Chinese stocks are silly here. Big fan of Alibaba, but it's not my favorite Chinese stock to be in. My favorite is JD. Been saying that for months and months and months at this point. JD has the same advantages that Alibaba has, but without the same degree of government scrutiny right now that Alibaba's been dealing with. Massively extended to the downside. Baba was tough. Maybe we could say that this trade didn't work if we want to be harsh on ourselves. Because this opening low broke and it kind of worked our way back down, worked its way back down, and this was tough to be able to execute this, and it still didn't close great. This Alibaba still has the potential to bounce back to $89 and still be bearish. But Baba was tough. JD was really solid, especially if you were buying this stuff versus like pre-market lows. Pre-market lows, I think, held for both stocks. But JD here, real kind of class act, constantly the relatively strong one in the space, immediately catching a high volume bid up. This one creating the higher low, whereas Baba broke the opening low, and then breaking up from there as well. So a lot of opportunity to make money in today's market to the long side, even as you don't trust the market here. And again, this all is, and I didn't even talk about this, a lot of this was just based off of that PPI. The PPI number being, oh, it's snowing out, being better than expected, really kind of set the stage for this relief rally today. And even with that, we had our common gaps basically get filled for the Qs and the IWM. Not fully filled for the SPYs, but came down low enough here to satisfy equilibrium and then kind of give your real rally from there. And once again, to repeat myself for the 5th time, this is really where an understanding of market dynamics is really important. So that you're not just saying, to take a step back, there are a lot of people out there who say technical analysis is the only way, fundamentals are BS. There are a lot of other people who say technical analysis is voodoo, it's BS, fundamentals are the only way. I think it's wrong for people to have that type of rigid thought process. I have seen that having an understanding of all of it and putting it together is really what's best. Because fundamentals work, technicals work, and a lot of what I consider to be fundamentals isn't necessarily sitting around and analyzing balance sheets. But that's what I got Stefan on the team for. It's understanding like the fundamentals of the market dynamics, and understanding, how this company has positioned itself for growth, what sector it's in, what does the management team look like, is there a buyback? Buybacks, such a big part of this market environment for the last 10 plus years, literally creating a shrinking market almost, I think, every year of my career, with the exception of probably last year. Last year may have been the only year of my career where the market didn't actually shrink. If you don't know what I'm talking about, I could talk about that for a while, but I'll probably cut myself off there. So that's pretty much it. That's all I got. Again, really good day today, I think, for the team. It's awesome that kind of for 2 days in a row here, every idea that we've had in the morning meeting has pretty much worked. Believe me, it's not always that way. Plan on me being wrong sometimes. But, so far so good. And we will, big question mark around tomorrow. So get that good nervous feeling. Get that good nervous feeling going on for 2 o'clock tomorrow. I know anyone who's traded for a while knows exactly what I'm talking about. All right, happy to answer any questions that you guys have. So I'm going to scroll up in the VTF like I always do to about 10 after 4. And I'll just kind of answer questions in order of how I see that they were asked. So first thing I'm seeing here is from Robert. Can we summarize expectations for tomorrow's Fed meeting? What's the final thought, please? Final thought is a lot of uncertainty. Pay attention to surprises. Surprises that are hawkish should bring the market down. Sometimes you see banks trade inverse of that. Surprises that are dovish should bring the market up. Sometimes banks trade inverse from that. And generally, news trades in the direction of the technicals, which is bearish. But my personal kind of feeling and thought process is that if expectations are perfectly met of the market, that it can actually lead to a further relief rally just because we're getting a layer of uncertainty out of the way. So that would be kind of my final summary for tomorrow. Next I'm seeing here is from Chinggis 51. I don't know what you mean by the number 51. Do you cover your R in a momentum stock all in one order, or do you spread out your offers? Sure, so this is more of an execution situation. It depends on how heavy I am and how thick the stock is, to be honest with you, Chinggis. Sometimes I'll spread them out. Sometimes I'll use refreshing orders, which would still be all in one order. But if I'm very big in something, and especially if the stock isn't super liquid, I don't want to show sometimes that I'm offering out 2,000 shares at one price. So that might be one of the circumstances where I use a refreshing order to hide my size. I like using refreshing orders in medium to low liquidity stocks if my bid or offer is going to be more than 500 shares. That's as a general rule. There are downsides to use. The upside to using a refreshing order is that you're hiding your order from the market. So the robots aren't going to be chiseling you. It makes it easier to potentially get filled. The downside of using a refreshing order is you don't get the rebate. So if you're working with a direct market access account, for the guests here, if you're working with a direct market access account, you get paid for providing liquidity to the market. I, in a typical month, get paid by the exchanges for providing liquidity to that exchange. If you utilize a refreshing order, you don't get the rebate on the limit order. And you constantly go to the end of the line. So if you, Chinggis, are sitting there with a 1,000 share refreshing order, and I jump on top of you for a 500 share order, my entire 500 shares needs to get filled, assuming I'm displaying my size, before the remainder of your refreshing order gets filled. So those are the downsides of using a refreshing order. So whenever I can, I want to be able to show my size and kind of get the rebate. But if you're too heavy, sometimes you can try to look for a refreshing order, or you can spread the offers out a little bit. The problem with spreading the offers out a little bit, if you guys have ever noticed, if you ever, seen a bid-ask spread that's more than a penny, it's called 5 cents. If you ever seen a bid-ask spread that's like 5 cents, maybe you're, I don't know, inside offer, and you say to yourself, you know what, I want to come into the spread because I want to get ahead of everyone who's also offered at my offer. So you decrement your offer by a penny. You ever notice how all that liquidity immediately joins it? It's all robots, and they're making it more difficult for you to get filled. So you actually tend to hurt yourself more than help yourself get the fill if you start tightening the spread up and decrementing the offer. The robots think there's desperation here. And sometimes it'll take a moment though, and then if the market really is going to work its way up, then taking you out actually becomes an arbitrage opportunity for a robot. But you'll see sometimes in these thinner stocks, you decrement into that spread, and all of a sudden the market's confused really briefly, and either all the robots start joining you, which makes it hard for you to get filled again, so you're in the same exact situation as you were, or in a moment, bam, all of a sudden some robot takes you out because of the way the market moved in that situation. It's a very, very small time for arbitrage opportunity. So you got some tape reading execution stuff. All right. I see a question here from Zauker from saying it right. It looks like Pat may have already answered your question. What's your take on large, far out of the money put buying on the indices? So Pat would be best qualified to answer this question. There's a 47,000 Q puts bought May 230 strike. Would you say it's insurance versus large portfolio? That's exactly what I would think. That's exactly what I would kind of think in that situation. But it's some sort of hedge. But that's one of those questions where Pat's definitely more qualified to answer than me. Pat's an expert in certain market things. From GB, you said you got into Apple pre-market, I'm guessing around 151-ish. It was actually 150. Was your stop around 150 based on the pre-market low and yesterday's low? So I announced really early into the VTF that I was putting on an initial Apple feeler pre-market. Pre-market low is actually 149. Here's my trading executions in Apple today, including the pre-market trading. This was me buying at 150, and I was actually adding it at 151. Took some off at 152, rebought it at 151, sold on the way up, rebought the dip on a little bit of stock, sold, and then sold some into the close. I was nervous about this one. Because Apple is the one who is going to deal with the brunt of the supply chain issues based on what's going on in China right now. But we had that pre-market low that came in kind of at 149. The entire structure of the market started to seem a little bit more bullish pre-market. We started to work our way kind of higher here. So I started with a small position at 150, and then I was able to add at 151 when things were starting to look better, and PPI had kind of come out at that point. And despite those concerns for the market, it is still one of the best companies that's out there. It has a rising 200-day, and it was extended to the downside. Apple trading at 150 with the ADMA at 157, $7 of extension in Apple is a $150 stock is a lot for this name. So that's kind of what I was looking at there, from a trade execution perspective. Hope that helps, GB. From Marty, what is your risk unit size when trading? So it's one of the things I'm restricted from saying is my exact tier size on the positions that I'm in. I can broadly say I can broadly say without getting any compliance issues that as far as P&L swings go, I'm typically swinging 5 figures every day, not 6 figures, not 6 figures. Though in this market environment there may have been a 6-figure swing on one of those days in this year, but for the most part, I tend to be kind of swinging back and forth on a typical day, low-ish 5 figures. But I'm not allowed to reveal my exact P&L, my exact tier size, my exact real pricing on things either. I start to run into compliance issues. From Steve, XLF volume was somewhat muted today, but overall good. Am I correct? You'd wait until XLF breaks over the 200 assuming you mean EMA, before entering. Let's take a look at the XLF. XLF needs to be above 37, and then I have an interest. And it is. The only issue here is the equilibrium zone, and the only other issue is, again, Fed. A lot of the times we see, not always, but a lot of times we see the financials move inverse to the market on Fed. Why? Because Fed influences interest rates. Higher interest rates can be bad for the market, particularly bad for tech stocks, while being good for financials. So I think we really got to see what happens tomorrow, like with many other things, specifically on the XLF. But I think the XLF looks better than it's looked for a while now. We recaptured the key 37 level. Yesterday we saw really good relative strength in the sector, even though it ended up being weak because the whole market was so weak it didn't close well. Bank of America was that focus for yesterday. And today we have an inside day. And that inside day is actually like, I don't want to overread the internal dynamics of this candle because of its location and equilibrium and because it's on low volume. But it's an inside day with a hammer shape to it. So overall here, I think financials are looking good. I don't need the XLF to get above the 200 day for me to get involved in it. I just need the proper setup. And I kind of also want to get past the Fed. From Marty, what market sectors do well at the beginning of a bull market? That's a good question. I don't think, and I guess I would start by saying that I don't have a super well-educated answer to your question. But from my experience, I don't think that every bull market starts in the same way. I remember in 2013. 2013 was a really strong market. The S&P finished up, I think, 32% on the year. That was led initially, the first half of the year, by consumer staples. Defensive stocks led the first half of 2013. And then financials took over in the second half. And that was attributed to fund underperformance. So the hedge funds were really underperforming the market, which was having a really strong first half of the year, but it was led by defensive stocks. So they started to pile into things that were more higher beta to be able to catch up. So that's actually an example of, a really strong year, a bull market that was started with more defensive type stocks that then led to high beta. But we've also seen the opposite, right? What led the market higher immediately after COVID? It was really tech. Tech led the market higher immediately after COVID, and that was more Fed related. So I don't think that there's a one-size-fits-all answer to your question. It is dumping snow out right now. I love to see it. Targhee, which you can see out my window, except it's storming too hard, I think it's supposed to get 18 inches this afternoon. I tell you what, guys, if I wasn't doing this open house, I might have to get the PAL flu tomorrow and take the day off and go shred the PAL. But I'm not going to abandon all of our guests tomorrow, no matter how much snow we get. Cool. Yeah, and then I see your follow-up question from Marty was what sectors do well in the middle of a bull market, and I'm just going to revert back to the answer that I just gave. I think it is kind of dependent upon that particular market. I don't think that there's a one-size-fits-all. It depends on all these different dynamics. What is the Fed doing? What does the market sentiment look like? But there does, and this is what your question alludes to, there does tend to be rotation throughout bull markets. That's actually the hallmark of a bull market, is that you have something that leads and it takes a breath, and then other things kind of catch up, and then that takes a rest or a breath, and then maybe the original sectors start to go again. So rotation is the hallmark of a bull market. We are not in a bull market right now. Tommy, even if we get a good setup tomorrow, is it best to sit on our hands once Powell starts speaking around 2? No, if you get a good setup, take your setup. Again, I think that the time that you want to err to the side of not trading is going to be between 10:30 and 2 tomorrow. Off the open, you got to set up, take the setup. And again, it tends to be that way at midday. Not 100% of the time. I have seen Fed days where the market was rocking and rolling and trending all day because of some other exogenous event that affected it or whatever, and there was opportunity, throughout the day. but it tends to be that between 10:30 and 2 you want to be cautious. And then, at 2 o'clock, 2 o'clock is going to be high risk, high reward. There's going to be a lot of opportunity if you really catch things right post 2 o'clock. And we'll do our best to navigate that as a team, like we always do, as we see the news hits. Pat typically does a fantastic job getting the Fed highlights into the room here really quickly. We're sometimes able to recognize certain news as being very bullish or bearish and kind of jumping on it. We'll see if we're able to repeat that again tomorrow. But yeah, your trades are there and you have the risk reward, then go for it, because if you do end up getting Fed follow through, I just invented that term. If you do end up getting Fed follow through tomorrow, could be big opportunity. And the snowflakes are like this big. Sick. Let's go. Love it. Love snow. From Marsh. When does hope go out the window and logic take over? I like to think that hope is out the window from the beginning, and logic is always there from the first moment. I know that's not always that way. Let me read the rest of your question. Let's say you're down 1,000 on a position. You don't want to sell for a loss. You think hope it will come back. See, this is why I hope you were paying attention to the class today. But risk it going down 2 to 3K. Then you now hope to get back to only a 1K loss. No. This is how retail people think, not how professional traders think. There is none of this going on. You, again, if you missed the class at 12 o'clock today, go back and watch it. You have a game plan before you enter the trade. So there's no feelings if the thing's down $1,000 and you game plan to risk 3. It just is what it is. You can't put risk on in the market that you're not comfortable with. If you are putting risk on a trade, whatever your dollar number is, 1,000, 3,000, $500, whatever your number is, you need to be comfortable losing that entire amount. It's like I said in the class today. You should almost imagine as if you were taking money out of your wallet, taking that $1,000 directly out of your wallet and giving it to Paul, whoever Paul is. Paul was the example I used earlier today. And if that trade works out, Paul gives you that money back plus a whole lot more. And if it doesn't, then that money was already out of your wallet. It's gone. So there's no hoping. It just is what it is. You put your trade on for a reason. You have a game plan. And then it just plays out. The way that emotions get involved is by not having a game plan to begin with. If you just say, oh, hey, I'm going to buy 1,000 shares of this stock, and you didn't have a game plan for how you're going to take a loss, now when you're down $1,000, you're nervous. If your whole game plan said I could lose $3,000 on this and you're down 1,000, well, you've got nothing to be nervous about. You already planned it. So there's no hope. There's no hope going on here. You have a specific game plan. And then the other thing of what you're talking about is like the most retail mentality ever. This is how retail people think. They think that the stock should go up, so they go and they buy it. The stock goes down. Now what do? They hope and they pray, please God, let my position go back to my price so I can get out of it without a loss. That's called unlimited risk for zero reward. It is literally the opposite of what a professional needs to do in order to be consistently profitable. So if you plan on risking $3,000 in a trade, you enter it, it starts to pull against you, you're down 2. Now it starts to bounce, and now you're only down 1,000. This is all meaningless. You don't care. Because that trade has not failed, it has not worked. It is still in the process of failing or working, and you're going to sit through it and you're going to let it play out. Second part of your question, same type of emotions. When that said stock starts to come back, what prevents or helps you from being greedy and just letting it go? It's the same answer. You got to check out today's class. You are greedy based on your game plan. You are greedy when your game plan says, okay, it's time to be greedy. There is nothing wrong with being appropriately greedy in the market. Like the guy from Wall Street says, right? Greed is good. Greed is good when you game plan to be greedy. When do you want to be greedy? When you're in a win-win situation. That's when I am max greed. We talk about it, become part of the team. We talk about it in here all the time. We talk about max greed. Oh, time to go max greed on this position. Felipe right now, sock sell, max greed. Let's go. All right, from CVO. What's the typical position size as a percentage of your trading account? So here's how I'm going to answer that question. So I think it depends on a number of factors, and one of those factors includes whether you're in a professional account or a retail account. But this goes back to a question that someone asked, I think, in yesterday's afternoon meeting about how much you should risk in an A-plus trade. And I said, you should risk your full day in an A-plus trade. So how much is your full day? What's your daily max loss? It should definitely not be more than 5% of your account. It should be probably less than that. So maybe you are willing to lose 3 or 4% of your account on a really bad day where everything goes wrong. So that means that on an A-plus trade, you might be willing to risk 3 to 4% of your account. But this is not typical position sizing. This is maximum position sizing in a super rare A-plus trade. So typical should probably be more like a quarter to a fifth of that. If you had, I'm just trying to use simple numbers here. If you had a $10,000 account, 5% of that is $500, right? So 3 to 4%, $300 to $400 is probably what you should max risk in a day. Let's just call it $400 as your typical daily max risk. That's also what you want to risk in an A-plus trade. And then your multiple grades become percentages of that. So, and if we're saying that a typical trade is probably a quarter of the risk or even a little bit less than your A-plus, than your maximum loss, then you would be saying in a $10,000 account, you'd probably be risking between $75 and $80 in a typical trade, $75 and $100 on a typical trade. So we're talking about 1% or less in an average trade. I just did that all off the top of my head. I hope that makes sense. From Lance, is there ever a situation to go into a position with large amount type stop and take multiple shots if it goes against you, as opposed to going in small and adding if it goes in your favor? Sure. So this also depends on the type of trade that you're getting in. If you're dealing with a momentum trade, you're generally going to be better off taking all of your risk in one shot. If you're dealing with like a support trade, like you wanted to get long that sock sell versus the big daily support at $27.50 or AMD versus $100, you want to give yourself room to be able to build into that position. I don't do a ton, which doesn't mean I don't do it at all. I don't do a ton of adding up. I'll add back. I think I have a Derrick the Trader YouTube video on this that you can check out. I think it's up there, where I describe the difference between an add and an add back. An add back is when you're taking back stock that you already sold at higher prices for cash flow. An add is when you're putting on new additional risk. So yeah, I think the answer to your question depends on the type of trade that you're getting into, and I hope that helps. Daylight saving sucks. Notices that the bots join his bid up. Yep, for sure. No problem. Zoker, if I'm saying that correctly. From Sebastian, would you consider the inside day today on DTE as actionable setup for tomorrow? Beautiful relative strength in this DTE. Look at this nice bull flag. This is a great looking chart. It's not extended. Yeah, this is definitely actionable for tomorrow. Look at tomorrow's high as a potential trade. Let's keep an eye on that one. From Widowson, can you explain how you effectively use the book, the order book, after you study a stock chart that you intend to buy? Sure. I have a whole class on, which is just an intro to tape reading as part of my training program. I think the T3 Live people call it a boot camp, which I think I saw Amber say that you get free access to if you sign up for ProDesk or something. I don't know. Ask them. I did see her say that what you got to do is email info@t3live.com and say, "Oh, trading." Oh, trading. In it to get the deal or something. So I do have a whole class in there, and if you're interested in tape reading, and that's just an intro to tape reading, I would recommend checking that out because we could easily sit here for 2 hours and talk about tape. The first thing I would say about tape, not the most important thing in trading, especially these days. And I come from a background of tape reading. Josh is very kind to give me a fairly consistent compliment where he says that I'm the best tape reader that he's ever met. And Josh has been in the business for a long time, so it is a really solid compliment. And it is a skill that I have. And I am the first to tell people that it is not nearly as important as it used to be. It's important in specific situations. It's important when there's news. It's important if you're trading an IPO. It's important if you're trading after hours like an earnings report. As a matter of fact, if you trade Apple after hours on its earnings report, it's all about tape reading. But those are specific situations. It's also important for execution purposes. And basically some of the things that you're looking for are liquidity to utilize or to avoid, depending upon the situation, and hidden liquidity, or the key things that you want to be thinking about when you're looking at execution. So if you look at the depth of the market here in the SPYs right now, and this is not, so first of all, like Pat said earlier, you don't want to read tape, especially in these ETFs. ETFs like the SPY, they are, this is the market, right? It's an ETF that represents the market. So it's not this is never going to trade on tape, ever. Because if there was ever like a weird bid or offer or buyer or seller or something kind of going on here that didn't belong at a certain price, it's an arbitrage opportunity to take it out. So it won't exist. It's not going to be the same truth for individual stocks. But because the SPY stays very liquid even after hours, I can just pull this up to, pull some things out, right? So, you as a general rule, you don't want to join high liquidity points. Not that 1,300 shares here is a high liquidity point, but if you saw a 40,000 share bid here, and 40,000 shares is significant for the stock, which is not for the SPYs because the SPYs traded 105 million shares today. But if I was looking at something that has an average volume of 500,000 shares and there's a 40,000 share bid, that's significant. I don't want to join that bid because it's going to make it very difficult for me to get filled. I want to be in front of that bid. But at the same time, I can also use those liquidity points to limit slippage. So if I'm trying to figure out a stop loss or sometimes a liquidity taking entry, well, what do I know if there's a 40,000 share bid? I know I can sell 40,000 shares into that person and get limited slippage on it because he's there to buy. So I can use that to recognize, well, I'm not going to get filled easily if I'm joining this person or I'm behind this person. I need to be above this person if I'm entering, or I can use that person as liquidity for an entry or for a stop loss to limit slippage. And then you also got to pay attention to, I answered Chinggis's question by talking about refreshing buyers or sellers, and that's where things become a little bit more nuanced, because good execution traders, and they're mostly robots these days for funds, they don't just say, hey, I'm here to buy 1 million shares, so here's a 1 million share bid. They work the order. They work the order all day, but they still have to work the order in some way. It's still coming into the level 2 in the tape in some way, but they're spreading it out. They're trying not to show the size. They're trying not to show their hand. But you can learn to be able to read those refreshing orders, and it's the same kind of information there, and it'll help you with that execution when you can read them. So that's a short answer to your question. Because it gets like super in depth, and I do think that my tape reading class is a great intro to starting to learn about tape. But if you're new to trading, tape's fine. Learn your charts. Cool. Lance, can you explain or point to best video on equilibrium? I think where I get into good depth on it initially is in my candlestick class in my training program. So once again, a shout out to that. I don't know where I got my concept of technical equilibrium in the market. Like I said earlier, I've learned from many different people in many different places over the course of my career, and I kind of put that together in a way that makes sense to me. I have definitely stolen things from other people as far as concepts go, and different things from this guy, different things from this gal, different things from this source, whatever. I can't point to where I came up with and it's a very fundamental core of my trading, is understanding that space between the 8 and 21 EMA as your technical equilibrium zone. I may have come up with that one entirely on my own. So, cool. From Marty, do you just do stocks or do you also do options? I trade stocks. And I both day trade and swing trade. I do both. I think as a directional trader in a proprietary trading account, you're much better off trading stocks than options. If you're in a retail account, then you can trade options. I'm not in a retail account. I'm in a professional prop account. If you want to learn more about the benefits of that, you can reach out to T3 Trading Group, which is T3's broker-dealer arm, which has both professional trading accounts and retail trading accounts. What's up, Natalie? Natalie wants to know about the oil stocks. We talked about them already a little bit. Good technical pullback. Great opportunity to buy Apache at 35 today. Great opportunity to buy XLE off of 70 today. Expect a lot more volatility. I don't know if Stefan fully sold rig. I'd be surprised. I think he took some off into the move. I have a favorite trading strategy that I use quite often. I have a lot of different types of trades that I take, and again, really kind of go through all this in my training program materials. I think that my favorite type of trade, if you will, just based on the current market environment, but I can say pretty broadly that simple breakout trades have been a good consistent one for a long time now. So usually, how to trade a breakout is the first trade that I teach to a new trader. That's my first training program class is about buying breakouts, shorting breakdowns, and how to trade support and resistance. Scrolling through here on the VTF. Take a look at Pandub. For you, Gabriel, anything. Pandub still looks really good. This pullback is more than you would like. Sick move here. I think this is off of earnings in late February, where it really kind of cleared through this like 535 area, which you'd like to see this thing making this exact pattern, but above 535. But we know that the market's been so weak, especially for these types of companies. It's not too bad of a thing that it's overshot that 535. This PanW is such an impressive company, man. And it's, if you compare this to your other typical kind of tech stock or stocks in the same business, this thing is just so strong. It is so hard to find one of these more expensive kind of techie type stocks that has had this type of move over the course of the last year and is still this close to its highs. Tremendous relative strength from the space. Clearing above 560 would be a really solid point for it, and it's a great looking candle today. We'll see what happens tomorrow. Tough stock to trade though because of liquidity. From Sebastian, aside from breakouts or resistance, what's the best way to enter or add to intraday trades? And aside from inside fives. Yeah, so inside fives is definitely a solid one. I like in a trending stock, hammer pivots. It's called a continuation hammer, different from a capitulation hammer. I like the continuation hammer setup. Various ways where you see kind of pivot points come in stocks that are trending to be able to get long off those pivot points. My favorite ways are the inside bar and the basically doji continuation kind of setup there. So you kind of covered it. I mean, those are some of my favorite ways to add. You have breakouts through resistance, you know, inside fives in equilibrium areas, they break out. Dojis in equilibrium area as they close to go long versus that previous pivot low. Those are really the main things I'm looking for. Follow-up question, do I wait for the hammer to close to trade it against the low? In theory, the answer to that should be yes. I don't always. Sometimes I get a jump start, I cheat. It seems very obvious to me how it's going to close, and I get a jump start on it. I've gotten in trouble doing that a couple of times. But sometimes, the flip side of that, sometimes you get even better price execution as a result of it. So, but in theory, you should wait for the candle to close. In practice, you can get away sometimes with getting a little bit of a jump start. All right, team. It's 20 after 5. I think this was a good afternoon meeting today. We covered a lot. I really hope that all of the guests here are learning and seeing the value of being a part of this community. We have a really strong community here. You can learn a lot. You know, this is not per day, Marty. This is not a situation where you're going to be able to just get a free week here and learn everything about how markets work and how professional traders approach the market. So would definitely recommend to everybody, you know, if you're enjoying your learning, if you see value in it. I mean, like I said the first day, the cost of admission here is so cheap. I got to do something about that. So that's probably another reason for you guys to try to get a jump start on this, because I'm definitely going to be talking to T3 about increasing these price points. The information that Pat gets into the VTF, even if you ignore every single thing I ever say, is worth the price of admission. So you guys know what to do. Reach out to the wonderful people at T3 Live, something about trading and some special deals or some awesomeness. I will see everybody tomorrow morning. We'll assess how the market gaps. We'll see, you know, our strategy pre-market for what's going to happen with the Fed day, and then we'll see what happens at 2 o'clock. Get that nervous excitement. Love that feeling. Makes you feel alive. Have a great night, everybody.